Hello, I'm Ma Xingyue, an investment advisor dedicated to helping clients achieving their financial goals through personalized strategies. In this presentation, I will cover four key topics. Understanding clients' information, three criteria for evaluating clients' information, discussion on active investment strategies, and investment strategies for four life stages. Firstly, to develop an effective investment strategies, I need a clear and comprehensive understanding of each client's unique situation. This involves gathering both quantitative and qualitative data. Let's break it down. Life stage information such as age, marital status, and career stage, risk tolerance, and individual's willingness and capacity to bear investment risk. It decides the trade-off between non-risk assets and risky assets. To construct a portfolio to a client's risk tolerance, I would align the portfolio with their level of risk aversion, aiming to select the highest possible indifference curve that is tangent to the capital allocation line. Investment goal: whether the individual is aiming for long-term investment for retirement or short-term investment for like vacation, cars. Understanding clients' goals, helping crafting a strategy that aligns with their needs. Life expectation decides what type of investment and level of return that might be appropriate. Knowing insurance coverage is crucial for understanding overall financial protection and planning, and it is important to evaluate current financial situation, which includes all forms of income received, monthly expense and budget, including irregular cash outflow, debt including mortgages and loans, assets such as saving, real estate, and other investments. If a client is experiencing financial difficulty, I will increase the weight of risk-free assets in their portfolio relative to risk assets. And the last, tax bracket, helping selecting investments that minimize tax liability and managing distribution caps to super. To evaluate a client's information and develop personalized investment strategy, I use three key criteria: investment goals, risk tolerance, and financial situation. By aligning these factors with appropriate investment options, I can tailor recommendations to each client's needs. For clients with short-term goals or high risk tolerance, I recommend a growth-oriented investment strategy. This is ideal for those with stable income and manageable debt level, as they can handle potential losses while pursuing higher returns. A diversified portfolio with a significant allocation to equities, growth stocks, or real estate can provide substantial growth potential over time. For clients with midterm goals and moderate risk tolerance, a balanced investment strategy is more suitable. This strategy combines equity, balanced mutual funds, and fixed income investments to manage risk while seeking reasonable growth. It works well for those with stable financial situation who desire a balanced approach to risk and return. For clients with short-term investment goals, lower risk tolerance, or a challenging financial situation, I suggest a conservative investment strategy. This approach should focus on low-risk investments such as a certificate of deposit, government bonds, or cash, offering stability and safety. This investment help him protect against market downturns while providing consistent income. Now let's focus on the discussion on active investment strategy. An active investment strategy seeks to place a portfolio above the efficient frontier by choosing securities that deliver excess returns for the same level of risk compared to passive approach. Constructing an active portfolio involves balancing factors such as expected return, risk tolerance, and asset correlations. The single index model helps to evaluate the effectiveness of an active strategy by estimating alpha, which represents the expected excess return over the benchmark. By focusing on maximizing the information ratio, active investments aim to provide the optimal risk-return trade-off relative to the benchmark, while stay within defined tracking area limits. Successful investment managers should carefully select and weight securities to align with clients' investment goals, manage risk, and strive for outperformance. Also, be a good listener. Investment managers must frequently communicate and fully understand their clients' financial goals and life expectations. They should personalize the strategy to meet the client's needs rather than focusing solely on personal performance metrics. Conduct fundamental analysis. They should excel in identifying undervalued assets through fundamental analysis. Utilizing metrics such as price-to-earning ratio or book-to-market ratios. Targeting companies with balanced growth and stable cash flow, especially those with strong quality and durability, often leads to better long-term performance. Identify mispricing opportunities. In markets characterized by uncertainty and information asymmetry, inefficiencies can create opportunities for generating alpha. Investment managers should exploit this mispricing, potentially constructing portfolio with a higher Sharpe ratio than the market portfolio. Timely adjustment and updates. By being responsive to market changes and new opportunity, ensuring that the investment approach remains relevant and effective. Before my clients making decisions, my initial recommendation is to assess their risk tolerance and investment horizon. They should determine how much risk they are comfortable taking and how long they can commit their funds. Next, enhance their understanding of various investment products and strategies, considering their level of experience with different types of investments. I also encourage clients to independently review the performance history of their investments. Additionally, it is crucial to examine the costs and fees associated with different investment options, including management fees, trading costs, and performance fees. Next, I will provide tailored investment advice for clients at different life stages. For clients aged 18 to 28 who may be starting families and buying their first home, a balanced investment strategy is recommended. The strategy helps generate substantial income for their home loan while also seeking growth or culminating their longer investment horizon and higher risk tolerance despite potential low income. Clients aged 28 to 40 who faced significant financial responsibilities such as raising children and supporting family members should adopt an aggressive investment strategy. Focusing on equities and growth stocks can capitalize on long-term growth, potentially meet their higher expenses. For clients aged 40 to 60 who might be upgrading their home, a balanced investment strategy is better. This approach will help pay down mortgages or other long-term debt while preserving wealth, aligning with their decreasing risk tolerance and income levels. Finally, for retired clients, the focus should be on ensuring a stable income and pursuing accumulate wealth. A conservative investment strategy that emphasizes stable income sources like dividend-paying stocks, along with a systematic withdrawal plan from super accounts, will help manage expenses and protect their legacy. Thank you for your watching.